and now 6 lakh divided by 15 lakh, as this ratio is also find out in percentage. Just check it out. Your answer would be it's around 40%. Answer would be it's around 40%. 54 or 60, it comes to 40%. So that means their operating profitability on operating profit margin in this company against the sales, it comes to 40%. Moving to the next ratio, and that is current ratio. Again, this ratio is also calculated earlier, so nothing new in this ratio. Just we need to identify the two variables, that is current assets and current liabilities. So just concentrate here. The current ratio formula is current assets divided by current liabilities. And now all of you just refer your balance sheet, and from the balance sheet we need to identify the current assets. According to my observations, we have a current asset: stock, debtors, bills receivable and cash. Stock, debtors, bills receivable and cash balance. These are the assets given in the balance sheet. If I am not wrong, just confirmed it. Stock is given, debtors, bills receivable and cash. Fictitious asset is given, but fictitious asset is not a current asset. That is not at all assets even. And the current liability, as we have a current liabilities, according to my knowledge, it's the current liabilities we have: creditors, bank overdraft, bills payable and outstanding expense. All last 4 items. Creditors we have, bills payable, bank overdraft and outstanding expenses. So these are the items given in the balance sheet liability side. Now if you are going to make a total of the current assets, the total current assets are 8 lakh rupees. Just make a total of all the 4 current assets which are mentioned here. The total of the current assets are 8 lakh rupees according to my observation. Please you just try to confirm it. And according to the current liabilities which are mentioned here, the total of the current liabilities comes to 3 lakh rupees. Total of the current liabilities comes to 3 lakh rupees. Now comparisons between these two. As I mentioned earlier, the denominator is always comes 1 in this type of ratio, where we are find out this ratio in proportion. That's why the denominator comes to 1. Now just make a division between these two variables, and the answer of this two variable comparison is 2.67:1. So 2.67:1, it shows that the company have a 2.5 times current assets than the current liability. That means it's very strong ratio. The company have a very strong current assets to meet all the current liabilities at the time of their maturity. So that may not be having a problem, at least for the near future. Company may be managing their all the current liabilities at least for the near future, because of they have enough amount of current assets against the current liability. Moving to the next ratio, that is a quick ratio. And the quick ratio, it's actually considered on the basis of quick assets divided by quick liability. Quick assets divided by quick liabilities. So now for the comparison of this quick assets divided by quick liabilities, as we already discussed earlier, again it's very easy. Current assets minus stock. That means from this calculation, if you remove stock from this, that is your quick assets. And in the case of quick liabilities, from the current liability, if you remove bank overdraft from it, so it means that is your quick liabilities. So only two things we'll have to consider when you find out the quick ratio. One is the stock and the other one is bank overdraft. Both the things would be actually removed from the respective item. So now we'll just have to check it out. After the stock has been removed from the current assets, what would be the now quick assets? It's according to the knowledge, 1,75,000 closing stock was given, so it was removed from the 8 lakh. The amount of quick assets is comes to 6,25,000. This is your quick asset, 6,25,000 rupees. And according to the observation of the bank overdraft from the liability side, it is 1,50,000. Oh, it's very huge. So total of the current liability is 3 lakh. Out of 3 lakh, 1,50,000 rupees is already carried by bank overdraft. So if you deduct it from it, the remaining amount of quick liability is 1,50,000, only half. And now you are going to compare, the base is 1, and then to find out the difference between these two items, your division, it comes to around 4.17. See these two ratios, compare it. In case of your current ratio, it's just showing 2.67:1. Just is also more than enough. Because of the 2.67, current asset is also more than enough. But why just? Because of when you are comparing with the quick assets, your quick assets is 4.17 times than the quick liabilities. That means it's almost 4 times than the quick liability. The company have a huge amount of cash and liquidity in their hands. Fine, maybe you can consider a positive thing because of the company have enough amount of liquidity in their hands to meet all the liabilities at their systematic time and their maturity period. But my other observation for this ratio is maybe company have an excessive current assets, and that excessive current assets and the quick assets may be reducing their profitability also sometime. So we need to be carefully checked out where the actually quick assets and some amount of assets excessive, which may be affected to the profitability in the future. And this is what all about the quick ratio is concerned. As we already discussed the few ratios which were already compared and discussed earlier problems also. Till that, the ratios which are actually concerned with the some amount of liquidity and the amount of profitability is compared to sales. Here, these are the ratios. Now we are going to discuss some little different ratios. One of the ratios we have already discussed, that is stock turnover ratio. That is also a part of turnover ratio. Here I am going to discuss the two ratios in front of you, and that is also related to a turnover ratio. One is a debtors ratio and the another is a creditors ratio. Both are the actually turnover ratio. That's the first thing. Ultimately, this ratio is actually showing an efficiency of the company, and that efficiency would be reflected through these two ratios. So how the company is providing a credibility to their debtors and how much amount of the credit period has been actually received from the creditors, and on the basis of this ratio comparisons, the company may be find out the liquidity positions and liquidity management in the company. This is a part of a working capital management ratio, and this ratio would be helpful to design the working capital requirement in the business, and how efficiency the liquidity can be managed, how the raw material can be purchased in the business, and how the goods has been sold out frequently, then the stock turnover ratio can be reflected more and more efficiently. So see here the formulas of the debtors ratio and the creditors ratio. The debtors ratio formula is debtors plus bills receivable divided by debtors plus bills receivable divided by average credit sales per day. So in that sense, the average credit sales per day you need to identify, and that is, you can find out that the total credit sales divided by number of days. Now for this information, just all of you refer the question. In the questions we have already the amount of informations where the sales are given in the revenue statement. The total amount of sales is given 15 lakh rupees. Total amount of sales is given 15 lakh rupees, and at the rate of 40% of cash sales. So it is mentioned that 40% is a cash sales. So in case of 40% is a cash sales, the 60% it's a credit sales, and the credit sales 60%, it comes to 9 lakh rupees. So that means we got a credit sales, that is the 9 lakh rupees. So from 9 lakh rupees credit sales, The another information we need number of days in a year, because of generally we find out the turnover ratio and these ratios on the basis of a per annum system, per annum basis. So see the question after the balance sheet, there is a one information that the number of days for the calculation is taken 360 days. Number of days is taken 360 days. So now here, just a moment, we will just take it out the part of this, and this is the amount of information that how we could find out the number of the concern, that is it's around 2500 average credit sales per day. It means that the 2500 its average credit sales per day when the comparisons of the total credit sales divided by the number of days which are given in the question. Now this item would be recorded, this item would be considered here in this main formula. So one variable we got it, that is average credit sales. Now see here the another informations which we have debtors and bills receivable value. The debtors and bills receivable value you can take it from the balance sheet. As per the observations, the debtors value is given that 3,50,000 and 50,000 rupees it's a bills receivable and divided by 2,500. These are the values, you can take it from the balance sheet, and 2,500 it's an average credit sales which you have already find out with the comparison of this. So now the division of this, and that is your final answer. The final answer is 160 days. So 160 days, it's a credit period offered by a company to their debtors. That means whenever the company made sales on a credit basis, at least they offer 160 days to their debtors. Now we will check it out, how much credit period they received from the creditors. And formula for that, the creditors plus bills payable divided by average credit purchase per day. For that they need to find out average credit purchase per day is equal to total credit purchase divided by number of days. Number of days is remain same in both the cases because of it is mentioned. The credit purchase which we can get it from the information of trading account, or maybe the other informations where we can get it the number of credit purchase or total amount of credit purchase. So see all of you revenue statement, in the balance sheet we cannot get it this item. So from the revenue statement just identify whether we have a purchase value or not. If you are going to see, they were actually given a vertical revenue statements, sales minus cost of goods sold, and then directly gross profit is given. That means they did not mention the amount of purchase value. So the purchase value, even total purchase value is also not mentioned. So the purchase, without purchase value, maybe this ratio would be find out very difficult, because of here they need a purchase value, because of the creditors ratio has been designed only on the basis of purchase, and that is also credit purchase. So here we don't have a purchase even. So how you can actually determine the purchase in case of the item is missing? At that point of time you can apply one simple logic, that the cost of sales is equal to purchase, and that purchase would be considered as a credit purchase. So in case of if there is a missing item, if the possibilities regarding the purchase is not available, you can think about that, whatever the cost of sales is given, that cost of sales is equal to purchases considered. So now cost of sales is given there. So from that particular revenue statement, if you identified from the 15 lakh, 7,50,000 rupees, they consider the cost of sales. So that we consider here as a credit purchase, the 7,50,000 rupees. And that 7,50,000 rupees, it's considered a credit purchase divided by number of days, 360 days. So let's find out first the how much amount of credit purchase per day. So the credit purchase per day, it comes to 2083.33. 2083.33. So it can be approximately 2083 average credit purchase per day. Now this value which you can actually consider for the main formula where the creditors and bills payable value is given. Now see, balance it, liability side, and identified your creditors and bills payable value. According to knowledge, 1 lakh rupees creditors is given and 45,000 rupees given a bills payable. So the total value of this is comes to 1,45,000. And you have average credit purchase from this formula, that is comes to 2083. So 1,45,000 divided by 2083, the difference it comes, that is around here, that the value is comes to 69.60. 69.60, that comes to almost 70 days. See here, now the analysis is beginning. Analysis is beginning when both the turnover ratio in your hand, and in that case the total amount of valuation of debtor ratio, it comes to in days, it's 160, which shows the company offered 160 days offer to their debtors. Where company purchases goods, at that point of time they would get only 70 days out of it. It means that if you are going to see the difference, the how much working capital required in the organization more, that is almost very close to 90 days. It means that the company needs more liquidity to manage their routine purchases, to run their business very smoothly, as well as their production should not be interrupted. Then the company needs more and more liquidity, because the company is not getting at least enough amount of liquidity credit period which was actually offered to the debtors, and there is a vast difference. So what they can take a decision from this analysis, the company has to take a decision. Number one is at least they should reduce their debtors period. That means the 160 days credit period is a very high period. If this is not possible, maybe the product is rare, then the market strategy is different, then they need to find out the people who can offer the credit more, as well as the quality of material is also remains same. So if the credit period is increased from 70 days or 69 days to a certain period of days, maybe 100 or 110, at least this could be more and more manageable, where the company can identify more feasibility to balance a certain things. So here this is a debtors and creditors ratio which we are actually find out. Now see here, the next ratio is a proprietary ratio, and the proprietary ratio, it is, we already find out the proprietary ratio in earlier case also, that is shareholders fund divided by total assets. So ultimately it's a comparison of the